Let's bring in one of the biggest bulls on the street in 2019. Tony Dwyer is joining, the Chief Market Strategist and Senior Managing Director at Canaccord Genuity. So, Tony, welcome back to the show. Thanks for being here. Tell me how the data point fits into your overall thesis for stocks.
So today, there's a couple of indications that the market's having a little bit of a washout, which doesn't take a genius strategist to tell you with the hit that we've had over the last few days. But it's actually been happening internally in the market for the last couple of weeks. And actually under 10% of stocks on the S&P 500 are now trading above their 10-day moving average. So greater than 90% are below their 10-day moving average. That's pretty indicative of a near-term washout. You couple that with the VIX being above 20, and those are signs that you don't really want to be selling here. And clearly, we're on an offensive positioning as we head into 2020.
So, Tony, when we have this market that is taking cues from different things to sell off, but generally doing it around kind of the same price or price to earnings valuations, I mean, what I'm saying is basically it was the ISM yesterday, but then prior to that, it was around some Fed speak, and then it was around a tweet before that. You know, is there just a pattern here where the market can't really sustain a trailing earnings beyond basically 19.5, 20? It seems like anytime we get there, something pushes us down. So do you want to buy lower, or do you want to, buy at 2,900?
No, I think you want to buy them here. I think, so there is no question, Oliver. It's a great question. There's no question in my mind that we're going to have volatility surrounding the hard Brexit, the impeachment shenanigans, all the different things that are at the China trade war and the tweets that come with it, all the things that are happening. That's what creates volatility. So the question isn't whether you're going to get days like today, and I've tried to be really clear about that. Our target for this year is still 29.50. It hasn't changed all year, but we're focused on next year's target because all those things that are in the background, we know that we're in a mini recession. There's no debating whether you're in a manufacturing recession globally. What I find interesting that kind of supports the markets getting a little bit washed out is even though some of the sentiment measures have come in a little bit higher than I would have expected, yesterday's ISM data was bad, and that's what tanked the tape. In the meantime, the market PMI manufacturing data coming out of China, Europe, and the U.S. all beat consensus expectations, and nobody cared. So clearly the market is kind of wrapped in fear right now, and historically that's what, in our view, creates an opportunity, especially when you see those data points globally inflecting off historic weak level.
So this, I think, is super important, Tony, and I like the chart that you brought to your newsletter yesterday and to your readers that showed where we are on the ISM, because the headline, the lowest in 10 years, correct, but really just basically in line with the mini recessions and routes we had around the debt crisis in 11 and then the energy crisis in 15, 16. But to me, it also, one could argue, is basically that we're kind of on the brink here, where if things don't turn up, then going down from here gets into territory that looks pretty darn rough. What does that mean for earnings? Because we've still got the expectations for next year slipping.
Well, that's actually a good thing. So if you go to dwyerstrategy.com, we do what's called Mythbusters. So first of all, when you look at the out-year earnings estimates coming down, this is one of the pushbacks against the bull story. How can the market go up if the out-year earnings estimates keep coming down? Yet that's exactly what's happened, not just in this cycle, but prior cycles. The only two positive, if you want next year's numbers to be revised higher in the out year, the only two times that's happened this cycle were the two negative years of 2011 and 2018. So what you want to see is the out year estimates coming in, because it means interest rates are going to stay contained. And again, Oliver, as you know, our case isn't that things are good global economy or domestic economy. They are not. What offsets that, though, is that you have dramatically lower interest rates. The guys printing the money have told us their game plan, right? And I get it. The markets are weak, and you're down from the peak. But it's a very different scenario than last year when the guys printing the money were continuing to tell you they were going to stop, not only stop, but aggressively stop. That's what created the fourth quarter last year. This year's different. This year, the guys are telling you they're going to print more money if things get worse, and they're clearly getting worse.
So, Tony, here's what we'll push back on it a little bit. And to your credit, you were right on this year, that the economic weakness being offset by Fed reversal in policy would be a bullish thing for stocks. But is there a point at which that Fed efficacy for the stock market comes under scrutiny? It seems right now the market wants good data. We saw the Bank of Japan basically saying, look, we're kind of run out of options here. ECB wants to pass the torch onto something fiscal. So does a 25 basis point from the Fed, I mean, can we really rely on that as being a big catalyst for further multiple expansion beyond the 19 we're at now?
Well, the only thing that will shut it down and make it a negative for the market is if credit shuts down. And that's the key here, is credit has not shut down. Of course, it's weakening a little bit with the stock market, but it's not leading the stock market. Their banks aren't tightening their lending standards. Mortgage companies and banking and shadow bankers are not significantly tightening their lending standards. I mean, just think of the number of people that I know, everybody knows, that have tried to refi or have refied their debt in the last few weeks because of the drop in rates. So our view isn't that we're not in this slower economic period. Our view is that we're in a mini recession, just like 2011 and 12, just like 2015, 16, where the S&P 500 goes into a bear market, which, by the way, it did in December, down 19.8%, right? And then you make the Treasury yield low a few months later. That's happened twice this cycle, and it feels awful when the Treasury yields are making the low and the economic data is bad, but each time the lower market rates in the 10-year Treasury note and other Treasury yields have kick-started economic activity.
So, Tony, this kind of brings me to the other side, and not to kind of wax and wane, but as we've described here, this sort of catch-22 market that's trying to figure out the kind of late-stage Goldilocks environment. I think it's important that, as you point out, that if we're already in sort of this manufacturing recession, but some of the other market manufacturing data points beating expectations around the world, we've heard the case now from two strategists this week that there might be a potential stabilization in the rest of the world. Is that not going to be a time for investment managers to maybe think about moving away from U.S. domestic stocks? If you get a little dollar softness, will they get bigger bang for their buck going somewhere that doesn't trade at elevated earnings?
It's a beta trade. It's a beta trade. It's not like when the Fed and the global central banks are printing money and telling you they're going to print more money, that it benefits the most levered economies. So typically EM over DM, DM over US, emerging markets over developed markets, that is. Also, the more offensive sectors. And again, I wish I were good enough to time it to the exact day. I'd be talking to you from my yacht, but I'm not. The things that are happening today and in the last week are surrounding or very similar to what happened right around the July low in the Treasury yields of 2016 and the July low in Treasury yields in 2012. It felt like they were telling us we're going to go into a recession. In 2012, it was the double dip everybody was worried about. In 2016, it was a global economic demise everybody was worried about as oil prices and commodities were tanking. And now it's the trade war. So there's clearly issues in the background that are slowing economic activity. But the power of lower market rates is and you brought up a great question about the Fed. Only, what does 25 basis points matter? The market has already done the Fed's work. The only job of the Fed is to not invert the curve enough to shut down incentive to lend.
How confident do you feel in that, as you describe it, the money printing thesis? I mean, the Fed is obviously caved when the market signals that it needs to with that yield curve inversion. But up until this ISM number, our data was looking pretty darn good. We heard the case earlier this morning from Andy Brenner at Nat Alliance that he doesn't see that Fed cut coming in October because they need to worry about repo stuff and balance sheet action. Is there a possibility that the Fed doesn't rush to cut based on manufacturing, which is only 12% basically of the economy?
Well, even Janet Yellen. Okay, let's put away that Trump keeps bashing Powell, Fed Chair Powell. President Trump keeps bashing Fed Chair Powell, so you say, okay, I don't like President Trump, so I don't want the Fed to ease. Even Janet Yellen, who is the dove that everybody on the Fed loves, even Janet Yellen put out a piece last week saying that the Fed is too optimistic to the U.S. economy. So the risk to the bull story here is the Fed continues to take an overly tight view of the marketplace. For months now, the market has been telling the Fed to ease aggressively. And what's interesting in this, in the stock meandering in the last couple of days, is you've had a pretty meaningful tick higher in the 210 yield curve.
Now, Tony, and I'd like to bring up the steepening here in the short term. I'm curious if I could kind of change course for just a sec by trying to basically get the pulse of the marginal buyer here, because again, we know stocks elevated in valuation on a trailing basis. We know that the market's still only, what, 4% off the highs? If you look at the Russell 2000, if you look at some of the, and again, a lot of people think I'm nuts to look at it, but this crash in the crypto, which is like the most speculative part of the marketplace in history, it looks like there is a avoidance of risk, judging by, I mean, even just take the Russell 2000, right? Is that going to be a problem for stocks overall?
Well, like today, the Russell 2000 is outperforming a little bit, right? Even the NASDAQ's outperforming a little bit. So it's hard to make the case. You know, again, this is kind of like a risk-off couple of few days in the indices that was already happening underneath the market. It was really kick-started by the IPO fears that are out there, especially with the WeWork debacle and the Peloton hit. So there's a lot of things that are out there in the marketplace that are scary, and there's not a lot of great reasons that you can see on the surface to be a buyer. It's not like the data is getting better or tax cuts are coming. But again, that's typically when you're surrounding a low, and you wait for those tactical indicators to come into play. And they're kind of doing that today with the VIX over 20 and the percentage of stocks above the 10-day below 10%. You know, that's typically surrounds what happens on a tactical low.
Tony, just to be clear before we let you go, because I know there's a fairly nuanced take here about the combination of economic weakness, but then also the Fed's role. My question to you is, if we tomorrow get ISM non-manufacturing, PMI services in line and robust and continuing to show that the most important part of the economy is strong, do you view that as a bullish thing, or do you view it as possibly bearish in the complication of what it means for the Fed's decision being harder?
No, I think you want to see it to be stable. I don't think it wants to be too hot or too cold. I think you want it to kind of be near expectations. Again, Oliver, it's not. We don't have to have the Fed ease unless the curve is inverted, which, you know, on the 210 it's not.
Right.
What you have to have is the perception that the Fed is getting ahead of the market. Right. So if the data comes in better and they've already eased twice and the yield curve's steepening, that's a good thing. So I think tomorrow, if you get better data, I want to start seeing better data. I want to start seeing the impact of the lower rates over the course of the last 6 months take hold in economic activity.
Yeah. Tony, sorry, second last question. For those watching then, is this a market where you want to avoid the very pure cyclical stuff? Are you just buying the utilities, the REITs, and the high growth names that have been working all year?
Well, let's forget my opinion, because who cares? The data and the reality is, if you believe that the 10-year note yield made a low on September 3rd, which I do, right? If you believe that's true, the playbook coming off of the third mini recession low is offensive sectors. So as ugly as it feels right now, I think, again, as long as that 10-year holds its low, I think you want to be offensively positioned.
All right, Tony Dwyer, good stuff as always. Appreciate it, Tony.